Welcome to our lecture series in Financial Basics. Today, we will talk about margin borrowing, margin accounts, and using leverage. Let's begin. Financial management tools like margin and leverage are powerful instruments in financial markets, allowing investors to control larger positions than their own capital would typically permit. While these tools can magnify potential gains, it's crucial to understand their dual nature, as they also significantly amplify losses and introduce substantial risks. Margin refers to money borrowed from a brokerage firm, enabling an investor to purchase securities by using their existing assets as collateral. In this process, the investor contributes a portion of the purchase price as equity, while the broker lends the remaining amount, with the purchased securities serving as collateral. For example, an investor depositing $5,000 into a margin account with a 50% initial margin requirement can purchase $10,000 worth of stock, borrowing $5,000 from the broker. Leverage measures the extent to which borrowed funds are utilized to increase the size of an investment position. A simple leverage ratio is calculated by dividing the total investment by the investor's own capital. So, if an investor uses $5,000 of their own money to control $10,000 of stock, the resulting leverage ratio is 2 to 1. Brokerage firms impose initial margin requirements, which is the minimum equity needed to open a position, typically 50% for stocks under Regulation T. They also set maintenance margin, the minimum equity percentage, that must be maintained in the account, often around 25 to 30%. If the account equity falls below this maintenance margin, a margin call is triggered, requiring the investor to deposit additional funds or securities. For instance, if an investor buys $10,000 of stock with $5,000 equity, and the stock value drops to $7,000, their equity falls to $2,000, resulting in an equity ratio of 28.6%. If the maintenance margin is 30%, this 28.6% ratio would trigger a margin call, and failure to meet it could lead to forced liquidation without investor consent. Leverage offers benefits such as amplifying gains, allowing for more efficient capital deployment, and facilitating strategies like hedging. However, the risks are significant. Losses can exceed the initial investment, margin calls may force liquidation at unfavorable prices, and interest costs reduce net returns. Market volatility further increases liquidation risk, as seen during the 2020 COVID market crash, where many leveraged investors faced forced liquidations at market lows. Behavioral aspects also play a role, with overconfidence leading to excessive leverage, loss aversion, delaying necessary liquidation, and emotional stress causing poor decision-making. In conclusion, margin and leverage are powerful yet risky financial tools that demand careful management and a thorough understanding of their mechanics and implications. Thank you for watching our lecture in Financial Basics, focusing on margin borrowing, margin accounts, and leverage. See you at the next lecture.